We're going to test our definition of expenses. We're going to look at a variety of transactions and see whether or not they meet the definition of an expense. And just to recall, an expense or expenses are decreases in assets or increases in liabilities that lead to a decrease in owner's equity excluding drawings. That's the full definition of an expense. Let's have a look at an example. Example number 1, paid $1,000 cash to reduce a loan. So businesses' cash resources have been reduced to reduce the liability, the loan, by $1,000. So the impact on the accounting equation, decrease in cash, $1,000. So yes, there's been a decrease in an asset, so part of the definition has been met. But the other impact is a decrease in the liability. The business owes $1,000 less than it did before. So assets down, liabilities down, no impact on owner's equity, therefore it cannot be an expense. Another example, drawings of cash $2,000. Let's see whether or not this fits the definition of an expense, which is decreases in assets or increases in liabilities that lead to a decrease in owner's equity, excluding drawings. Well, if the owner takes $2,000 cash out for their own private use, certainly assets will go down, in this case by $2,000, so part of the definition is met, decreases in assets. And it will also lead to a decrease in owner's equity because drawings is a negative owner's equity item. So it must be an expense? No, because the definition excludes drawings. It cannot be an expense. Another example, the payment of GST. Let's assume that it was $400 paid, perhaps it was for rent. It doesn't matter what it was for, but the business paid $400 in GST. Is this an expense? Assets go down because they've spent $400, so part of the definition has been met, decreases in an asset. But the payment of the $400 GST reduces the GST liability. It has no impact on owner's equity. Hence, it cannot be an expense. It does not lead to a decrease in owner's equity. Example number 4, paid $3,000 cash for a computer. Does this meet the definition of an expense? Well, there's been a decrease in an asset. Cash has gone down by $3,000 to buy the computer. But because the computer is an asset, there's been an increase in assets of $3,000. So one asset goes down $3,000, one asset goes up $3,000. There's no net change to assets, and there's certainly no impact on owner's equity. Hence, this cannot be an expense. And as we know, the computer is an asset. So the payment of cash for an asset is certainly not an expense. What about paying $1,200 cash for advertising? We're going to exclude GST in this example. It would have no impact anyway on the expense. Paid $1,200 cash for advertising. We would decrease cash $1,200, so part of the definition has been met. It's a decrease in an asset. And it leads to a decrease in owner's equity because it is an expense and expenses reduce owner's equity. So it does meet the definition of an expense, which is a decrease in an asset or an increase in a liability that leads to a decrease in owner's equity excluding drawings. Later in the course we'll look at examples that are consistent with this part of the definition, increases in liabilities. That comes later in the course. Common examples of expenses. The biggest example in a trading business is cost of sales. Other common examples include rent, stock loss, interest on loan, cleaning, discount expense, loss on the disposal of a non-current asset, wages, power and light, insurance, etc. Lots of other possible examples. You'll become very good at identifying those over time. Let's have a look at one other example, and this is the cost of sales itself. Let's assume we sold stock which cost $600. That is, the stock itself was originally purchased for $600. Let's examine the impact of this transaction on the accounting equation. Come back and see video 3.